So there's something I'm starting to see talked about out there, and a lot of retail folks are starting to say things like the recession is priced in, basically meaning that even if we have a recession, stocks will either go up or maybe just stay flat and no major downside. And so when I see something like this talked about, I say, let me dive into history. Let me dive into company numbers, valuations, and let's really ask ourselves, is the recession priced in, or are we not even remotely close and we actually have massive downside ahead in the stock market? And that's what we're diving into. This is a very in-depth video. It took me several hours to put this beast together. So this is one of those videos I think you should save in your notes on your phone or your computer or something like that and come back to this video every once in a while. Most of the videos I put out are relevant for maybe a few days, maybe a few weeks. I think this is a type of video that's true financial education. I feel like this is a video that's going to be relevant years to go in the future, because we're going to look back at history, we're going to look at the current state, and we're going to think out to the future and where these stocks should be valued and what is really priced in and what is not priced in or even remotely close. Also, if you know any friends or family that might enjoy a video like this, share it with them. This is one of those few videos I put out that definitely I think is going to help out a ton of people, okay? And thank you everybody that's subscribed to the channel. Thank you everybody that always shows up for the videos and enjoys these, okay? Let's tackle this beast of a subject, okay? First thing I want to start out with here is understanding where companies are valued at over time. The main way to value stocks in the stock market is not the only way, but the main way to value whether it's the S&P 500 or just stocks in general is through a PE ratio, the price to earnings essentially of a company, okay? And if we look at the price to earnings of companies over time in the S&P 500, what we're going to find is even though the market has come down, and it came down from really high numbers, right, is we are still trading on the richer side of what you would expect for companies to be priced at, okay? Still, even after this come down. And if you look back at coming out of the great financial crisis for several years, at where PE ratios were coming out of that, right? We had rates at zero, we had quantitative easing, and we had strong earnings momentum coming out for companies. Basically, companies' earnings bottomed around 2009, like late 2009, or even mid 2009 for some companies, and then started to come back very strong in 2010, 2011, 2012, 2013, 2014. And this is where things were valued then. So we're actually way above this. Now think about the market we're in right now. Rates are anywhere but zero. They are extremely high and getting close to 5% Fed funds rate, right? We no longer have quantitative easing like we had in this time. Now we have quantitative tightening. And earnings are starting to falter and will likely falter a lot more in 2023. So the high probability is P ratios are going to have to get more into this range, which means, unfortunately, the market has a long way to go just based upon valuations of companies on a P ratio, right? No, this makes sense because if you think about this for a moment, right? As the economy gets stronger and stronger over time, right? Which is certainly what happened. You know, economy kind of bottoms in 2009 and then slowly starts to come back to life in 2010, 2011, 2012, and moving on from there, right? As the economy gets stronger and stronger for several years, people's wealth climbs, right? People get richer, right? Their assets go up and all those sorts of things, right? They have more money in their savings account, bank accounts, right? And what do people like to do? Well, they either go spend that money, which helps companies' earnings go up, or they go ahead and buy things like stocks and real estate, right? Those are the two main asset classes. So they buy stocks, they buy real estate. Now, when folks buy stocks and they buy real estate, the issue is stocks get more expensive. Real estate gets more expensive over time, right? Which is exactly what we saw play out and where we peaked at here, essentially, which was just peak of kind of wealth building and just like, we're all going to be billionaires or something like that, right? And that's what we saw play out there. Now, the inverse happens, and the inverse is what we just started here in 2022, okay? Is the economy starts to weaken for several years. And as the economy weakens and weakens, right, people's wealth doesn't go up. It starts dropping, right? And so people start selling stocks. They start selling real estate. This is what happens. And stocks and real estate get cheap. So rather than expensive, they start getting cheap. And they get valued more properly where they should be valued, or maybe at undervalued valuations, right? And you see that for housing, and you could look back at real estate during this time period, same exact thing. And things get much, much cheaper. Now, if we want to think about Mr. Cycles, right, who's Ray Dalio, legendary investor. Mr. Cycles, he goes into very depth quite often about leverage and deleveraging cycles, right? And he talks about the beautiful deleveraging of folks in a lot of people getting into a healthier place, right? But unfortunately, in a deleveraging cycle, you're going to have earnings get hit in a massive way. You will have unemployment go up. You will have, companies just get in a much weaker place as the cycle is deleveraging, and that's healthy for the long term, but it's extremely painful in the short term. Now, ask yourself this for a moment. I have a question for everybody watching this video right now, okay? My question for you is, have we just entered a leveraging cycle, or have we just entered a deleveraging cycle? I hope everybody that's watching this video right now understands we have just entered a deleveraging cycle, and we have just exited a epic, massive leveraging cycle. So in 2022, it's the year of coming to the realization of, we're actually entering a deleveraging cycle, which means a lot, and I mean a lot of short-term pain, but it is for long-term gain in the end. But it is a lot of short-term pain when you go into a deleveraging cycle, right? Now, when you go into one of these deleveraging cycles, what you see is big ticket purchases fall in an epic way. And you saw this in the great financial crisis, which was a bit of a deleveraging cycle for folks, right? What happened is U.S. housing starts fell off a cliff, and they stayed low for years and years and years, which killed, obviously, the construction industry and all the businesses, the manufacturing businesses, and all the other businesses that benefit from all the construction of new homes, new apartments, new everything being built. If you just remember back to that time period, there wasn't a lot of construction activity. Very different than right now, where there's massive amounts of homes being built, apartments, warehouses, everything like that, right? Now, not just that, you have many other things that falter as well. Other big ticket purchases, such as vehicles, for instance, fall quite substantially in a deleveraging cycle, which is something we're likely going to see start playing out even to a bigger extent over the next 1 to 2 years, is vehicle sales dropping in a pretty substantial way. And the thing about these sorts of items, right, whether it's a home being built, whether it's a new car being made, things like that, those are some of the best things that can ever happen to an economy. And the reason being is those things are basically bought on debt, but they produce an immense amount of jobs. Think about how many jobs go into producing a new vehicle, right? Think about how many jobs go into producing a new home, how many businesses make money off a new home being built, right? And all the wonderful things that people buy for their new homes and the appliances and the furniture. It creates so many jobs and so many people make money off that it's a beautiful thing when you're in kind of that leveraging cycle. But when you're in the deleveraging cycle and you're talking about home sales starting to drop in terms of new housing starts, when you're talking about new vehicle sales starting to drop in a major way, it has this awful effect on businesses, on companies, on folks that basically have to do with all these massive buildings of all these expensive items. And it hurts the economy in an epic way, and then those folks aren't making that money, so they can't go out there and spend in the economy. And so it's a very vicious short-term cycle to go through, but it is something you have to go through in a deleveraging cycle, right? And if we look back at the personal savings rate over time in the United States of America, right, what you're going to find time and time again, and especially anytime in recent history, is when folks don't have much to spend out there, the economy starts to falter. And it starts to falter in a major way. And we saw this play out just prior to the great financial crisis. You saw a lot of folks, basically savings start to fall to the 4% range, 3% range. And this was essentially a cycle that ended up in a massive recession, right? Now, guess what happened? As the recession was kind of ticking along and we came out, people's savings went up and up and up, right? It was deleveraging, and so people got in a healthier place. And what happened is company earnings went up and up and up over those years, right? And you had people have a pretty good savings amount for many years, so we had a very healthy economy for about a decade roughly, right? And then we had the blow off top of a booming economy when obviously all the stimulus money was out there and all the money the government pumped and the Fed pumped out there, right? And so we had this boom that made company earnings go to the moon and made companies like Louis Vuitton have to have lines just to get into their store. I remember going to the mall in late 2020 and into much of 2021 and just seeing the Chanel store, the Louis Vuitton store, and all these fancy stores that sell extremely expensive things. These stores had lines, people lined up with masks on just to wait to get in there just to buy a $3,000 bag. Like absolute insanity like I've never seen ever. That's never been a thing ever. That's never, ever been a thing. But that was a thing in the back half of 2020 and into almost all of 2021, into the very beginning of 2022. Those long lines to get in those luxury stores to go spend $3,000, $4,000, $5,000 on a new bag, those are long gone. Now at this point in time, people just wanting to bid up real estate and throw in any price, those days are gone. Those days are gone. Okay? And that's what we're seeing continuously out there now at this point in time. And where you might be wondering, where are people's savings at now? It's awful. We're all the way down to 2.3% personal savings rate. Look at back where we're usually at. Okay? We're usually 5, 6, 7, 8, 9, sometimes even if you're really good, 10% plus for savings rate. We're down to 2.3% before the holiday shopping season. What does that mean? That means people have no money. And if they are going to spend any money out there, it's credit cards. So that is a bad, epically bad situation nonetheless, okay? And we actually need unfortunately, we need a major recession and a deleveraging so folks can hopefully get themselves in a better position, kind of similar to what we saw play out in the great financial crisis. Although there was a lot of economic devastation, what happened is people actually got themselves into a better financial position, even throughout that recession coming out for the next few years. And we actually need something like that to play out, because I can only imagine. Where do you think this number is going to be in January? 1.7%, 1.5% savings rate? Like, it's not going to be pretty. It's going to be bad, right? Now, priced in. Let's talk about this for a moment. When it comes to the Dow, let's just go through some of these companies. I want to go through some of these companies and point out to you how overvalued these stocks are and how much further they actually had to fall. So if we look at the Dow weighting, okay, the most heavily weighted stock in the Dow is a company named United Health Group, okay? So United Health Group, and I want to look at also Goldman Sachs, Home Depot. We'll go through all, most of these stocks that are the biggest weights inside the Dow, okay? But starting out here with United Health, okay? So United Health, look where the P ratio has gone for this stock over the past number of years. That's not where it should be. This stock is heavily overvalued now at this point in time. The fact is, for a company like this, it should be valued substantially less than it's valued. This stock is at minimum 30% overvalued right now, but it really is closer to 50% overvalued right now for this company. This is not anywhere remotely where this stock should be trading at. And it unfortunately has a lot of downside ahead, not because the company's bad, not because of anything like that, simply because the company is massively, epically overvalued right now. This company needs to go under a 20 P ratio, and it's nowhere even close right now. But ideally, it really needs to get into the 15 P ratio to be fairly valued for a company like this. It has a long way to go, and that's the biggest weight in the Dow. The biggest weight, okay? Think about a company like Goldman Sachs, right? You might think this stock's great. Goldman Sachs is a grete company, but likely it's not going to have a great next year. And analysts are kind of in denial in this situation. They have the company growing revenues. Meanwhile, watch the actions of executives over time. And if we look at this, okay, Goldman Sachs plans to cut thousands of jobs amid the investment banking plunge, right? Goldman Sachs plans to lay off thousands of employees to survive the current uncertain economic conditions. Why is a company like Goldman Sachs also going to cut thousands of jobs? They're cutting thousands of jobs, not because they think, the economy is going to boom and we're going to make so much money. They're cutting those jobs because they are of the belief that it's going to be tough sledding, very tough sledding for at least the next year, if not several years. And those are the Wall Streeters that are the most, basically in the know that you could possibly. And so they might smile in your face and say, everything's great, economy's fine, we're going to be fine. But at the end of the day, when those same folks are cutting thousands of jobs, preparing to cut thousands of jobs, alarm bells should go off when you should say, where are their actions? Where are their actions in this situation, okay? If you look at a company like Home Depot stock has two major problems. One, it has a valuation problem, and the second, it's about to have a business problem as well, okay? So valuation-wise, Home Depot is priced way too expensive right now. This is a stock that should be priced around a 15 P ratio, if not like a 14 to 12 P ratio on the stock. And it's been trading at, 20-ish P ratio. So right off the bat, it has a valuation problem with this company. But it's about to have a business problem, okay? If you're talking about a massive slowdown in new homes being built, apartments, construction in general, which is very realistic in starting to play out in 2023 and as we get closer to 2024, right? Home Depot's net income will fall, and it will fall substantially. There's no company that probably benefited more from just this overwhelming great economy of like super low unemployment, rates near zero, stimulus money, everybody being forced to be home because of Rona, right? And wanting to do things like paint their homes and all the remodels that happen as home prices appreciated, right? Home Depot benefited more than anybody in the most unnatural way possible, okay? And what we know is that's not normal for Home Depot's business. That's not normal at all. And so for a company like Home Depot, I'm not even going to predict that their net income drops to where it dropped, basically coming out of the great financial crisis, which was $2.6 billion of net income, right? If we just say Home Depot's business was to go back to 2014, 2015, which was a very healthy business. It wasn't a blow off the top business like they had the past few years with everything that's been pumped out there, right? And housing at record highs and everything at record highs, right? If we just say they go to like roughly where they used to be at, to 2014, 2015, which is still not even predicting a disaster situation for Home Depot. This is disastrous situation. $3 billion net income for Home Depot, that's disaster, okay? So we don't even have to predict a disaster. We just predict things weaken a little bit, okay? If you're talking about this company to $6 billion of net income on a 15 PE ratio, which might even be high, right? We're at a $90 billion market cap. If you want to slap a 20 PE ratio on it, which is way too high for the stock, but if we want to go ahead and do that, right? $6 billion net income, 20 PE ratio, you're at $120 billion market capitalization for Home Depot. $120 billion. Now, where's the stock value today? The company is valued at $323 billion. And we didn't even price in a disaster. We didn't even price in an epic disaster. We priced in like things are okay. It's certainly not like it's been, but it's still good. Like if Home Depot brings in $5 to $6 billion in net income, that's good for this company. And so check out where those valuations are at and check out where that stock is priced today. That is very, very scary, okay? Let's go through the next ones. Amgen and McDonald's. Where are these companies priced at? Well, Amgen right now is trading at a 21 PE ratio, roughly somewhere in there, versus this stock, for a long, long time was priced between about a 10 P ratio and 15 price to earnings ratio for this company. And right now it's at a 21. So a company like Amgen, unfortunately, it has further to fall just on a valuation basis. The stock could fall 25 to 35% easily, and then would be somewhat priced fairly then at that point in time, right? McDonald's is a WTF situation. Why does the stock perform so amazing? Why is everybody flood money there? Because everybody's concerned. Everybody left, obviously, the growth stocks in 2022. So like pile into McDonald's. Well, the problem with this is it's created a valuation problem like I've never seen in McDonald's. This is the most unhealthy stock, maybe company, obviously the products, right? In the world, right? This is incredible. This is absolutely incredible, and this will come to an end. This will come to an end. This stock cannot be priced like this. A stock like McDonald's, give me a break. This is a stock that should be priced for sure under 20 PE ratio. Throughout its history, that's where it's usually at, right? And if you go back to even the recession time period and coming out of the recession, this is a stock that had a price to earnings ratio of 10, 12 on it. And right now it's up near 30. Give me a break, man. That baby has a long way to fall. Once again, just on a valuation basis, nothing else. It's not like McDonald's is magically the worst company in the world. They're just among the most overvalued stocks in the stock market. And it's a stock you would never think about. When people think about overvalued stocks, they think about some sort of high growth stock like a Tesla or a Shopify or Amazon or something like that, right? Or even an unprofitable company that has massive growth. You never think about McDonald's as being epically overpriced. And that stock right now is epically overpriced. And like I said, the whole, well, we might be going into recession, so McDonald's does good. No, that argument, that doesn't shake out like that. The bottom line is this stock is at least 50% overvalued. Doesn't mean it's going to drop 50% plus, but it is right now over 50% overvalued on that stock. It is absolutely the most insane thing I don't want to say ever seen in the stock market because I've seen a lot of insane things, but it's certainly one of those, okay? Let's go through the next two stocks here. Microsoft and Caterpillar. What about those stocks? Well, I gotta say, Microsoft's not crazy. This one maybe has a little downside ahead, but it's not trading crazy. Now, you might look back to this time period and say, well, it's way above where the PE ratio was in this time period, right? Correct. But Microsoft had a massive change in their business model that the company's valued differently now because of now their recurring revenue streams and obviously their cloud products. Everything's like recurring revenue streams. So the company naturally is going to command a higher PE ratio moving forward than it did back in these days. So I look at this one, I don't think it's crazy valued. I think it might have a little downside ahead, but not crazy downside like many of these other stocks, okay? You look at a stock like Caterpillar, here's the deal, okay? This is another one you got to be scared of. So when times are tough for Caterpillar, what we know is this company does $2 to $3 billion of net income when times are tough, right? You look back at the 2020 numbers, you look at 2014, 2015, you look at 2010, right? Obviously, 2009 was really ugly for them at less than $1 billion of net income, right? So that's when business is really ugly, right? And that's certainly numbers that could be a possibility for 2024. I don't think 2023 because they got a good backlog going into 2023. But as the year ticks on, I think their backlog is going to dry up more and more, and they could end up in some major trouble as the year kind of ticks on. Now, we don't even say they're going to earn $2 to $3 billion, which is where their trouble numbers are for net income. Let's just assume Caterpillar their net income goes down to like $4 billion, let's say in like 2024, right? At a 15 PE ratio on $4 billion, you're at a $60 billion market cap, right? A $60 billion market cap. Where's Caterpillar valued today? Double that. It's valued at $120 billion market cap today. So this one could easily have 50% downside. And we're not even assuming it's one of these sorts of numbers. Never mind this sort of number, right? We're not even assuming it goes there. We're just assuming it's a $4 billion type number, right? So think about that for a moment. Just think about that for a moment, right? And think about the type of downside that could be ahead for a stock like Caterpillar in 2023. Because believe me, as the year ticks on, if the numbers keep coming in worse and worse, the backlog keeps coming in worse and worse, the orders coming through come in worse and worse, that's when people are going to start coming to the assumption that, 2024 is going to be bad for Caterpillar and maybe 2025 as well. And so you'll see a massive sell-off in the stock as 2023 rolls along because the people don't wait until the numbers are all bad in 2024, especially for a stock like this, because people realize, things are getting bad, faster than expected. No, people assume that, the Dow just holds up really well or something like that, when in reality it doesn't. It might at first, and I'll explain why that is when you're first getting into one of these cycles, but at the end of the day, it goes down pretty much just as much as any of the other indexes in the end. And you look back at the great financial crisis, by the end of that thing, the Dow had fallen over 50%. It lost over half its value. So the bottom line is, when you're in a medium recession, or especially a bad recession, the Dow falls dramatically, just as dramatically pretty much as the S&P 500, and pretty much just as dramatically as the NASDAQ. People just assume, that's the one that just fine, okay? And here's why. Dow stocks are similar to a freight train. This is how I would describe them. So Dow stocks are similar to a freight train. It takes them a long time to start falling, and it takes them a long time to start going up in a major way. They're slow on both sides, okay? And so when the economy starts to falter, those ones, the stock prices don't necessarily fall down right away, which as 2022's rolled along, we kind of see the economy starting to get worse and worse into a worse and worse place, right? And going to assume it's going to get much worse actually in 2023, right? And so the Dow has been slow to react to this. It's a freight train. And a lot of these companies are a freight train. It takes a while for it to start to really hit their numbers. But when it starts to hit their numbers, oh boy, okay, things come to a grinding halt. And then to get those stocks back moving in the right direction, that's an uphill battle. Similar to a freight train, you don't just go to top speed right away. They're slow to go down, slow to go up, very different than the other stocks we've already seen falter in a massive way, okay? And I would give this analogy. The tech stocks, the NASDAQ, right? These are similar to like a Plaid, right? A Model S Plaid. Fast reactions. It's quick, man. And that's why you've seen the NASDAQ and tech stocks do so poorly, while the Dow stocks have held up well this year, because it's slow reactions. And people get excited and they think, these stocks are the safe ones and these are the bad ones, when it doesn't work like that at all. It's just the tech stocks and the higher growth ones, those ones are the fastest reactions. Those ones sell off first, and they sell off the hardest first. But by the end of it, the freight train catches up. The freight train catches up, okay? And so you could see this, obviously, in the numbers in regards to this, right? Because you look at the NASDAQ's down 33+% this year, versus the Dow's only down 10% this year, right? But the Dow will catch up. It's something we always know throughout history. And if you study history of the stock market, you know the Dow always ends up catching up in the end, right? So this baby will catch up. It's just a lag. It's just hanging back there, right? It's a freight train that is starting to come to a grinding halt, and it will come to a bigger halt, obviously, in 2023, and then it will be the slowest to react on the upside. So what you could actually see is you could see the NASDAQ start to come back maybe toward the end of 2023 in a major way, maybe even starting in the middle of 2023 if the Fed makes certain moves, or in a situation in 2024, while the Dow actually still could be potentially falling or lagging. Because remember what I spoke about with a lot of those companies, right? Think about companies like Home Depot and Caterpillar. Even if the Fed switches rates or something like that, the economy is not booming again. Home Depot's numbers will continue to get worse for at least a year, if not several years. A company like Caterpillar, numbers will get worse for at least a year, if not several years. And so stocks like that will continue to falter, will continue to fall to the wayside and be in a very, very tough scenario, okay? They're a freight train. They're a freight train, okay? Now, if you look back at the great financial crisis prior to that, the Dow was giving you signals that everything's fine. And it does this, okay? This was even in April of 2008, when you had to assume the market must have been falling apart. Meanwhile, the Dow was hardly down. It was hardly down. It was giving this interpretation, this impression, let's call it that. It was giving this impression of like, everything's fine. Nothing's bad is happening here. Don't worry about it. We're all good, man. And what you ended up seeing was the market absolutely fell off a cliff, okay? It fell off a cliff. So what we can find so far, right, is if we're talking about a like a medium recession to especially a bad recession, the Dow has a long way to fall, and much of that damage will come in 2023 with a potential of a little bit more damage in 2024 if we're talking about the economy really starts to falter, which looks like a very realistic possibility. What we know is the NASDAQ's already gotten ahead of this and getting hit in a major way. That does not mean the NASDAQ is safe now, and it's only up for here for the NASDAQ, because the NASDAQ could easily fall more as well. The NASDAQ will potentially outperform the Dow in 2023 because that one already got hit so much. You're talking about such a divergence there, and the Dow has to play catch up in that game, okay? And as the stocks get beaten down more and more and more, people will go to those sorts of stocks that they feel are they going to be the best as we come out of the market. So think about stocks like the Amazons and the Teslas and those sorts of stocks, and you'll see a rotation from a lot of those insanely overvalued Dow stocks to actually many of the very undervalued great tech companies that are starting to be priced in a pretty attractive way, right? Never mind imagine the NASDAQ falls another 10% from here, 15%. Imagine where some of these stocks are going to be at that point in time. Maybe an AMD's in the 40s at that point in time. Maybe a Tesla's at 120. Maybe an Amazon's at $70, right? You're talking about very different valuations. Maybe an Apple by that point in time is at $100 or something like that. So very different valuations, and that's where money starts rotating. And so the main thing I can preach to everybody out there is patience. Everybody wants this crash to just be over. It's been a brutal 2022, and everybody just wants this to be over. And the main thing I can preach to everybody out there is patience. Have patience in this situation. Things got to play out here. Don't get too excited either way. Hope you guys enjoyed this. Always appreciate you. Thank you for joining me. Thanks for being subscribed. That was a beast video, and have a great day.